Tuesday, June 7th, 2022, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the Italian government bond market. Yes, I think that market is in meltdown mode, and it could force the ECB to go brrr even more. The ECB is still doing QE. Before I start though, I like to talk to you a little bit about my background because it will help you understand how close to the Italian government bond market I used to be. And yes, I worked for 20 years in the city of London. Before I came to London in 1992, I worked for a small private bank in Switzerland for about 3 years. That's where I started out in finance. I learned all about all asset classes, but my bosses were more into bonds, so I learned a lot about bonds as well. When I came to London, I worked for Cantor Fitzgerald, as a bond broker. I wasn't too happy after a while there, and eventually I was recruited by the biggest UK-based futures broker called GNI. And I was recruited to work with an Italian guy called Luigi. And he was on the government bond futures desk. And I joined them there, futures and options. And all our clients were in Italy. They were the major banks in Italy, the major brokers, the major corporate treasury desks, and also mutual funds. So that's how I started in the futures market. And trading Italian government bond futures in the early to mid 90s. They're called the BTP futures. The 10-year BTP futures was a blast. That market was so volatile, especially prior to Italy joining the single currency. And before I show you some of, or go through some of my notes that I have from actually ABN AMRO Bank, where I went to work in 1997. I just want to give you a quick story of when I went to see one of my big clients. He did a lot of BTP futures. He used to throw around a couple of hundred lots back and forth when the market was very volatile. Well, he worked for a bank, and I went to visit him in Milan to take him out for lunch. And he actually wanted to take me out for lunch. And when I got there in his office, he said, well, Mario, we're going to go out for lunch with the Pope's nephew. He wants to take you out because the Pope's nephew happened to be the guy trading those BTP futures. Because the way it worked was that the bank in Milan, they didn't have access to the London Financial Futures Exchange where the BTPs were traded. But we did. Our firm GNI had access to that. So they traded with us, and his client traded with him. And that's how it worked. So yeah, we went out for a really nice lunch in Milan with the Pope's nephew. He was a really nice gentleman. And yes, his uncle was Pope in the 60s. Before Paul VI, so you can probably work out who it was. So back to my notebook. I had a look at this the other day for some reason, and this is kind of like what you call a jobbing book, and I'll give you an idea of how I used to get to my desk every day around 7. I used to write what was going on in the markets and in terms of politics, economics. I used to take notes down. I used to write the support and resistances for the contracts that I used to trade, which were government bonds, interest rate futures. So just to give you an idea, it looks really messy, doesn't it? But someone called it organized chaos. I'll give you another idea of, this is how it was, you see. And a lot of times I used to get orders that I had to, for example, someone would give me an order that they wanted me to work it in clips over like 15 minutes. So I used to write down what I was doing, and afterwards, of course, we used to input all these orders into electronic ticket machine. We already had those. This is from 1997. So the reason why I'm showing you this book is not to show you how messy it was and what I did, but it's to show you how Italy has always been like, I would say, not really fit to join the single currency, the European Monetary Union. It never really fulfilled the rules that they had for European Monetary Union. One of them was a 60% debt to GDP ratio. Italy never had that. The other one was running a budget deficit less than 3%. And I think the third one was to do with the CPI. It had to be below 2%. I'm not too sure. But yes, we were talking about this 25 years ago and it hasn't changed. And that's why I think what's going on now is very significant. So this is from my notes from 23rd of September, 1997. And this is what I wrote down. Ciampi, I think he was the prime minister at the time, I'm not sure, confirmed Italy would aim to enter EMU, European Monetary Union, from start. Narrower spreads helping Italy to stability. And now I have something about Tietmeyer. Who is Tietmeyer? He was the head of the Bundesbank, the German central bank. It says Tietmeyer said he expects convergence. While convergence was like the Italian government bond yield dropping to converge with the German, and that would be a good thing, right? And you'll see why that is important today. Of short rates for those countries joining EMU with fixing of exchange rates spring 1998. Tietmeyer's comments should help shorten even further. Tietmeyer said, however, that only EU countries with sound fiscal positions can join European Monetary Union or EMU. Bundesbank doesn't seem as flexible as German government. That's what I wrote down. So you can see that this has been going on for 25 years, this saga. And about 11 years ago, there was a sovereign debt crisis in Europe. And it started in Portugal, Italy, Ireland, Greece, and Spain. They called those countries the PIIGS. Yes, PIIGS. And by July 2012, things were getting bad again in July 2012. Yields had dropped, like Italian government bond yields had dropped, but they had started picking up again. So at the time, the head of the ECB was Mario Draghi, right? A former Goldman Sachs banker who actually, along with Mark Carney, helped countries like Greece and Italy fiddle the book, so to speak, to join the European Monetary Union. They worked for Goldman Sachs. I mean, it's known that they fiddled the books so that Greek government finances could look better. So it seems like these guys, they've been at this for decades, and they're still around trying to clean up this mess or keep things going, because Mario Draghi now is the prime minister of Italy, a caretaker, not elected prime minister. So I'm going to play you a clip that was a historic comment from Mario Draghi back in July 2012. Because yields had started to go up again. The crisis wasn't abating, the sovereign debt crisis. And that crisis, if Portugal, Italy, Ireland, Greece, and Spain went, all the other countries in Europe would have gone. And eventually, yeah, it would have been mayhem. So this is what he said.
There's another message that I want to tell you today, is that within our mandate, the ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
So that was Mario Draghi's whatever it takes moment, or his bazooka moment. So here we are now in June of 2022, and things are getting pretty sketchy again, I would say. I noticed yesterday morning prior to the market opening, there's this story here in the ECB to firm up plans to ward off bond market stress. Council members likely to commit to counter any turmoil triggered by higher rates. So ECB, of course, wants to have its cake and eat it. They want to say they're raising rates, but at the same time, they're going to increase QE to stabilize the Italian government bond market. And you'll see why it's so important to stabilize the Italian government bond market in a minute. So it says here the bulk of the 25 governing council members are expected to support a proposal to create a new bond buying program if needed to counter borrowing costs for member states such as Italy spiraling out of control, according to several people involved in the discussions. So I bet you the German council members are probably not too keen on doing this, or the other northern countries. Notice that it says the bulk. And then late yesterday, this is from Il Sole 24 Ore, which is like the Italian equivalent of the FT or Wall Street Journal. It says, and I translated it, ECB ready for the shield. So that's what they were talking about earlier. But the BTP suffers the same. It suffers anyway. The spread breaks through 220. What's the spread? Well, that's the spread between the Italian BTP, 10-year BTP yield and the Bund, the German Bund's 10-year yield. You remember the convergence talk in the late 90s. The narrower that spread is, the better it is for the system. But when that spread starts widening, that means Italy is in trouble. That means the Italian government bonds are dropping in price and their yields are going up a lot faster than the German ones. So that's what happened yesterday. And let's go back to history a little bit here. And I've got the PIIGS, as you can see, PIIGS, Portugal, Italy, Ireland, Greece, and Spain. And you can see where the rates went back in 2012, 2011. The Italian 10-year yield went up above 7.5. The Greek went into the 40s, right? Ireland went into the teens, I would say. Yeah, 15%, it looks like, 14. Portugal went up almost to 20%, and Spain went up to around 7.5%, like Italy. So if you look at these yield charts, and the thing with the yield charts is that they're the opposite of bond prices. So when bond prices drop, which is a bad thing, yields go up. When yields go up, it has huge repercussions for the whole of the economy in these countries and everywhere else. It means the cost of credit and financing goes up. It means that the value of bonds go down. And a lot of these countries have rules that pension funds and government pensions, private pensions have to hold these things. So it could be catastrophic if these bond markets collapse, if Italy goes bust, and it could, if Greece goes bust, or Ireland, Portugal, and Spain go bust, and it could spread like wildfire. It could, because a lot of other countries own, and banks own these things. It's a mess. But as you can see, that was when Draghi made that whatever it takes comment right there. You can see in July 2012. And after that, they've been able to keep these yields down. But as you can see, we have a falling wedge there. Looks a lot like the oil price chart. And we know what's happening to oil. So this could go a lot higher. And this is not the spread. This is the Italian government bond yield. So it's gone from below like 0.5% about a year ago to now almost 3.5%. The key level is going to be the high there from around 2018, 2019. I think it's around 385. So I don't think it looks good. I don't think the ECB will be able to contain this unless they go brrr, big time. And that could force other central banks to go brrr as well. It could be the excuse for the Fed's pivot. And why would that be? Well, because I think U.S. Treasuries are doing the same. Their yields are going up, and it might have a little bit to do with the Fed raising rates. But I think this could spread like wildfire. It could be a contagion. It could be like the first domino to drop, Italy. And before we go further, just wanted to show you the PIIGS in terms of their debt to GDP. And I took this from the US debt clock, from the world debt clock. And you can see that Portugal has a debt to GDP of 146%. So as I said, this could spread very quickly. Ireland, on the other hand, has sorted itself out. Its debt to GDP is relatively low at 75%. So maybe the PIIGS will become like the animal. One of the eyes might drop and Ireland might be okay. But if it spreads like wildfire, if it is a global crisis, I don't think Ireland will escape. Italy, as you see here, debt to GDP, 175% almost. So that's not good. It's supposed to be no more than 60%. Don't forget, that's one of the rules for European Monetary Union. Greece, 234%, and Spain, 110%. With that, let's quickly look at where the markets are this morning. I am a little earlier today because I'm going to go out to London. I'm going to go out for lunch with one of my old friends from the city. He doesn't work in the city anymore, but he's a gold bug like me. So we keep in touch a lot, him and I, and we're going for our second lunch this year to talk about things. So it's 7:45 a.m. We've got spot gold up $1 at 1843. High's been 44 and the low 36. We've got silver down 13 cents at 21.95. High's been 22.13, low 21.84. Dow futures down 180 or 0.5%. Nasdaq 100 future down 112 or just under 1%. S&P 500 is down 26, 0.2%. The FTSE is down 30 at 75.86. Eurostoxx 50 is down 31 at 38.08. To the currencies and a little bit on Boris Johnson. Yes, he won the no confidence vote that the Tory Conservative Party had on his leadership. But 41% of the conservative MPs voted to oust him. So that was like a Pyrrhic victory, I would say. And one thing it could do, well, there's a few things it could do. He could really just resign because, I don't think he's got much legitimacy even though he won the vote. But he could also try to hang on and go brrr in terms of fiscal policy and make everyone happy and give out even more handouts. And that could hurt the currency. It could hurt the government bond market as well. We're seeing gilt yields also rise quite quickly. We're almost at 230 already. Recently, we just broke through 2%. So this morning, we've got sterling down 0.5% at 124.68. It has been down as much as like almost 1%. It got down to 124.29, so it has rebounded a little bit. The euro is unchanged, 106.87. Dollar yen is up 0.6%, 132.66. So the yen is floundering as well here. And the dollar is up versus the Swiss franc, 0.2% and 97.26. And the dollar is up 0.2 versus the yuan at 6.67. And the dollar looks strong, but the dollar is just the best of all these bad fiat currencies. And the US is not in a different position than Italy or any of these countries. The US is up to here in debt. And I think the ECB and the Fed and the other central banks are going to go brrr again. They're going to start QE and printing. And that might stabilize the bond markets, but it's going to make their currencies eventually look like confetti versus real things like gold, silver, and commodities. So that's what you need to keep in mind, in my opinion. To the other currencies, Aussie dollar is unchanged, 71.98. Dollar's up slightly versus the loonie, 125.97. Loonie is the Canadian dollar, and the Kiwi dollar is down 0.5% at 64.61. General commodities, not helping the program, so to speak. WTI crude is up 0.8%, 117.76. Brent crude is just below 20 at 119.64. High-grade copper down 0.7% at 441. U.S. nat gas approaching 10. We're at 933.60, up 0.5%. And to finish off, let's look at the bond yield, or the 10-year yield, sorry. It's unchanged at 3.05, so that's also had a move higher yesterday. Let's see if the BTP market, the Italian government bond market hasn't really opened yet. Probably opens in about 10 minutes. So we'll keep an eye on that. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And yes, I wish you all a great day. Take care. Bye.